welcome back to Women, Wealth, and What Matters. I'm Tracy Burns. I am a financial advisor. I'm an MBA, CDFA, and Vice President of Women and Investing at Lebenthal Global Advisors. Thank you for showing up again and coming back. So I've spent a bunch of my career covering the markets and taxes and money. Now I'm on this mission to help try to clear it all up for everyone. I, in particular, help women take control of their finances. Because here's the truth. You don't need jargon. You don't need to feel intimidated. You just need someone to explain it to you clearly. And that's it. So whether you're building wealth, going through a transition, or just trying to make smarter decisions, you're in the right place. All right, quick reminder. You're going to learn 5 things, and then you are going to get on with your day. We're all juggling a lot. So this is quick to the point. And before we dive in, though, please check out our previous podcast. Actually, my favorite was the one we did about what to do when the headlines get loud. And man, oh man, are they loud these days. So for context, it is also Financial Literacy Month for those that follow that kind of stuff, which is actually why we're going to talk about what we are today. And to dive into today's topic, in honor of Financial Literacy Month, I thought we should do some vocabulary. You know, it's funny, when I was thinking about prepping for this, I was an English teacher in high school back in the day when I was trying to figure out, I was in between careers. So I get a job at an inner city high school teaching English. And the only way I could get these kids to play my dumb vocabulary games was to take them outside and play, I think it was horse. Is that the game where you like shoot around the court, whatever? And they would take shots every time they spelt a word right. I swear, it's true. I thought of that this morning. Anyway, all right, so here's the truth though. The financial world isn't that complicated. It's just explains terribly. So we're going to go through that today. There's jargon, there's acronyms. It's just vocabulary. We're going to have a vocabulary lesson. And we're going to go deeper in today, and we're going to touch on a bunch of different areas in the market that I think could use further explanation. Because there's a lot of people, myself included, throw these words around sometimes, and people just nod, and you presume they understand, but they don't really understand. You know, people say the Fed or the yield on a bond. Well, what does that mean? And if you don't know, this episode's for you. If you know someone who doesn't know, this episode's for them, but we'll get to that point later. Okay, so the first thing we're going to talk about are this amorphous blob that is equities, stocks, dividends, all the things. What is that? Let's start with equities. Equities are stocks. It's just a fancy way of saying it. So when they say the equity market, that's just a fancy way to say the stock market. Equities, stocks, same word. Now, a stock is an ownership in a company, right? If you own a share of stock, it literally means you are a partial owner. So I own a share of Apple. I'm a partial owner in Apple. That's pretty cool, right? That means you get to participate in the growth, in the profits, and sometimes even the income, which is where dividends come in. But so this is the beauty of the stock market. It kind of democratized ownership of all these companies. You buy a share, you get to benefit in how well that company does. It's like the old school American dream on some level. That is why you should be in the stock market. That is why we encourage people to be in the stock market, because you deserve ownership in this country. Okay, so now let's talk about income. When a company has extra income, they may or may not give it back to shareholders as a dividend. It's basically returning their profits to you. And so no company is legally obligated to give you a dividend. The thing is that once they commit to a dividend, it's really hard to take it back. If you come out and you say, I'm going to start giving a quarterly dividend to my shareholders, and then you reverse it, the street, the market, all the people that look at stocks are like, whoa, what just happened that you're taking that back? Something bad must be going on inside. So that's the only thing I would say to be aware of. But basically, companies make a decision on whether or not they're going to pay a dividend. Let's just take a company that has some profits. They made money, they paid all their bills, they have something left over at the end of the day. So what do you do with it? Well, you could reinvest it back into the business. That's what like these high-flying tech companies do. They hire more people, they build products, they expand plants, they do all the things, they put it back in the business. You could also, number 2, hold it as cash, emergency situations, right? I have this extra income that is not allotted to anything, so I'm just going to hold it because I know I got some big bill coming up or something to that effect. The third thing you could do is pay it back to shareholders in the form of a dividend, and that is really cool. So why do some companies pay dividends and others don't? It comes down to, the maturity level, the growth of the company. If the company's in growth mode and they still want to get bigger and bigger, they're not giving you back your money. They're just not. They're going to go buy another plant or make another widget or do the things that they're doing, right? But if you have like a big old timer, like a Coca-Cola, they have extra money. Well, I don't know. Do people still drink soda? Who knows? But anyway, they have all this extra money. They give it out in a dividend, and they give a consistent, fabulous dividend. A company like Costco gives a consistent, fabulous dividend. So your younger, faster companies, fast-growing companies, they're just going to reinvest everything. No dividends. So think about your big tech. They want more innovation. They want to reinvest. Your mature, stable companies like your PepsiCo's, Coca-Cola's, Johnson & Johnson's, they pay beautiful dividends. They have steady profits. They're not like blowing it out of the water as far as growth opportunities go. They're just going to keep making soda and doing what they do, right? They pay dividends. So your key takeaway here, dividends are not extra. They're a strategic decision. And what I love about this is this statement that you always hear is you get paid to wait when you own a dividend stock. So if you own, we're picking on Coca-Cola here. You own Coca-Cola and the market is down. The price of Coca-Cola has since come down, but they committed to that dividend. You're still probably going to get it. Unless catastrophic things happen, terrible things, it is very rare for a company to take back on its promise to give a dividend. You just don't do that. You just don't do it. So companies that pay dividends, whether the stock's up or down, they say in the business that you're still getting paid to wait. You're getting paid your dividend to wait out the roller coaster ride that is the stock market. All right? I love it. So you have one company that says, you know what, we'd rather hold on to this money, invest internally. The other says, I want to return it to shareholders. Last thing I will say about dividends, they are taxable. You can have your dividends reinvested. So my daughter was on someone bought her shares of Coca-Cola and we had her dividends reinvested. So every time Coke issued a dividend, we reinvested it back into and bought another share of stock. So she amassed more and more shares. But those dividends, even though I never saw them, nor did she, were taxable income come tax time. Know that. So if you are in dividend producing stocks, the dividend piece will be taxable as ordinary income come tax time. So it's not free money by any stretch. Okay, number 2 now. Let's talk about the fixed income bond world. This trips people up because they use words like yield and coupon. Who the heck knows what all this means? Fixed income basically means someone is lending money. You are the bank. So you could have a bond that is part of the fixed income world. You could have a municipal bond that is also part of the municipal world. Treasuries issued by the federal government, also part of the fixed income world. These are just loans issued by different entities. So when a company, let's pick on JP Morgan this time, they issue a corporate bond, JP Morgan is saying, we need some outside money right now. JP Morgan's building that monstrosity in Texas right now for all their people to go work there. So let's just pretend they issued a bunch of bonds because they need money right now to build that thing. So corporate bonds are sold in $1,000 increments. They issue a bunch of bonds. And again, I'm making this up. Let's just say they offer a 5% interest. By the way, that is a great bond. If JP Morgan's offering a 5% interest, we should all take it. But you give JP Morgan your $1,000 and they said, over the next 3 years, we're going to hold your money. We're going to pay you that 5%. Let's just call it semi-annually, twice a year. And then at the end of the 3 years, you're going to get your $1,000 back, right? So they have your 1,000. They're going to go take it and put it towards the building and do what they do. And you, on a semi-annual basis, so twice a year, will get that 5% in 2 payments. So 2.5%. Let's call it June, 2.5 in December. And then again in year 2, you get your 2.5. Year 3, you get your 2.5, and you get your $1,000 back. That is how a bond works. You get your principal back in theory, and a lot could happen, and there's many reasons why you don't, but if you hold to maturity, you get your initial investment back, plus you've gotten some interest payments along the way. A lot of old people like these things because it's guaranteed. They know what they're getting. They've not taken the risk of the stock market. All right? So a municipal bond works the exact same way, except that the entity that needs the money are your local municipalities, a local hospital, school system. They issue bonds because, well, school needs a new playground. You're going to buy these bonds, these municipal bonds. The good part about municipal bonds is they are federal interest free And if the state is issuing the municipal bond, that means it's state tax free too, just the interest. But municipality offers, says we need money for something, park, the streets are all chopped up, whatever. You buy a bond and you get your interest payment. Much like the whole JP Morgan scenario, same thing, except the person paying you now, the entity paying you now is a municipality. Same story for CDs. CDs, though, are loans issued by a bank. A bank needs some money. They issue a CD. You buy the CD, you get your interest payment. At the end of the term, you get your initial investment back plus your interest. This is all part of fixed income. So when people say you should have some fixed income in your portfolio, you should say to them, clarify. Do you mean corporate bonds? Do you mean municipal bonds? Do you mean CDs? But then there's treasuries. Treasuries are bonds issued by the federal government. Say what you want about the federal government. They do pay their bills. So you go buy a treasury, you give the government some money to use, they pay you an interest until the treasury matures, you get your money back plus your interest. It's kind of safe. It's kind of safe. People like it. So corporate bonds have higher yields, though, or interest rates than, let's call it a treasury, because the corporation basically can set their own rate. They can kind of figure out what they want to pay you. So yield equals interest rate. So if I said the treasury is yielding 3.5%, it means it's paying an interest rate of 3.5%. Yield is a fancy word for interest. So don't let that confuse you either. Corporates are generally have higher interest rates, then probably will jump to munis. CDs get a little lower, and treasuries, CDs and treasuries lately have been right around the same, but they're definitely lower than some good corporate bonds. Just know all this. Just don't let it be foreign to you. The fixed income market could be very confusing, but again, it's just a bunch of words. Yield means interest. When people say it's got a coupon, it's the same thing. It's the interest rate that it's paying. It's called a coupon because back in the day, like when my grandfather was around, he actually had a book with coupons in them on his bonds. He would pull out a coupon, go to the bank, and they would give him his interest payment. That's what they did back then. They cut coupons, much like I used to do. I know nobody does this anymore, but I actually cut them out of a magazine and walked to, not a magazine, a newspaper, and walked to a food store with my stack of coupons. I know, that's how old I am. All right, let's move on here. ETFs versus mutual funds and what happens behind the curtain. I try very hard to be nice about mutual funds. I don't love them. I just don't. And this is where people, unfortunately, truly don't understand what they're even owning. Okay, so an exchange-traded fund, an ETF, is a basket of stocks that trades like stocks. It's just a basket of stocks, which means you can't have a big fee on this. You're not doing a whole heck of a lot. All you're doing is following a basket. So whether it's the S&P 500, which we'll talk about in a minute, or the NASDAQ, that's the basket. It's made up of stocks. You can't change it. So the managers aren't really doing a lot except following this basket. So the fees are generally low. That's why they're not working that hard. They're also very tax efficient because they trade like a stock. So you buy it, you sell it, you have a capital gain. It's cleaner, it's simpler, it's more transparent. I'm a fan. On the other side are these mutual funds. And these have been around forever. I know. They're professionally managed. They're diversified. A lot of people have done very well in mutual funds, and they're going to yell at me and all the things. But there's all these hidden fees that you just don't know about with a mutual fund. There's an expense ratio. Drives me bananas, the expense ratio. There could be an annual fee baked in. There could be a fee if you pull the money out too soon. There could be a fee that you have to hold it for a certain period of time. All this is in there, kind of foggy. And then on top of that, manager discretion with a mutual fund. They can buy and sell whenever they want. If they create a capital gain, though, because it is called a pass-through entity, the gains come to you. So you didn't sell anything. You didn't sell your shares in the mutual fund. Internally, within the fund, the manager decided they were going to, let's just, for argument's sake, trim some of their Apple position, created a capital gain. You get the bill. That's the part I can't. It drives me bananas. These fees, I know they could be like 1%. I know it sounds like nothing, but it adds up. After 20 years of paying 1%, you're eating away at your potential gains. If you own mutual funds, I beg you, just read the fine print. What are you paying? Just find out, what are you paying? We've talked about these hidden capital gains too. People need to understand. I have clients in big mutual funds that are legacy. They were not my decision. And at the end of the year, they get a capital gain. And it's a distribution. It is taxable. You have to pay taxes. Some years it's a surprise. Just all I ask, now that you know what all these words are, now that you know that mutual funds have hidden fees, expense ratios, call the people, call the mutual fund company. What are they? What are they? I want to know. You want to understand in plain English. You didn't do anything, but you may get a tax bill. Why? Because mutual funds pass this stuff on, like I said, and people get surprised. Don't be surprised. Just don't be surprised. You want to stay in your mutual funds? God bless. Just understand what you're invested in. Like I said, ETFs, a little bit more, exchange traded funds, a little bit more tax efficient. And my key takeaway here is with mutual funds, you're not just investing, you're sort of inheriting the decisions of someone else. You have less control, and as a result, could have a bigger or a surprise tax bill. That's all I'm saying. Mutual fund companies are going to come at me. I know it. Okay, let's talk about the indices now. I love this. What is the S&P 500? What is the NASDAQ? What is the Dow Jones? I will never forget. Someone once said there are thousands of stocks in the S&P 500. Do you want to take one guess at how many stocks there are in the S&P 500? 500. 500. There are 500 of the largest U.S. companies in this basket. So if you own an ETF an exchange traded fund that follows the S&P 500, you own a little piece of all those 500 companies. That basically means you get a good sense of the market. You own most of the market. You cannot buy it directly. There are mutual funds that track the S&P 500. There's a lot of portfolios out there that track the S&P 500. But ownership in something that replicates it basically means you're kind of getting the whole market in one shot. And that's like a pretty diversified, semi-safe way to go, right? You own one share, you own a tiny little piece of 500 companies, boom. That includes Apple, Microsoft, Amazon, JP Morgan, whom I adore, all of them. Instant diversification across America's biggest companies. Love it. Again, 500 companies in the S&P 500. Standard & Poor's came up with this index moons ago of 500 companies that they thought would represent the overall economy. And it has changed over the years. I mean, as you can imagine, when Standard & Poor's created this thing, they were still like big rail companies and like, lots of oil, and all that stuff has changed over the years because now, as you know, there's big tech companies making up the S&P 500. So it has changed. It's evolved with the economy, but it's a representation of the economy. The Dow Jones Industrial Average, very similar, only it has 30 companies in it. That's it. And Dow Jones, you all know Dow Jones. They track data. They have a ton of information on their site. Their advisory board at one point sat down and did the exact same thing. Came up with 30 companies that they thought would represent the economy. 30 is tough now these days. And the 30 have changed over the years. Less representative, but it's very headline friendly. You turn on a business channel and they're like, well, the Dow is up 10% or the Dow is down or whatever, blah, blah, blah. We've been reporting on this for years. I think old habits die hard. To be very honest, we probably should drop it. You should pay attention to the S&P 500 and then the very tech-heavy, growth-focused NASDAQ composite. The NASDAQ has all the, most of the, I should say, tech companies, and most of the companies in the NASDAQ. The ticker has 4 letters. The Dow has 3 letters. So Johnson & Johnson, Dow. Apple, AAPL, 4, NASDAQ. It's generally how you can figure out. Granted, there's times that doesn't work, but that is generally how you can figure out what indice they sit on. Tech heavy, you could also buy an ETF that tracks the NASDAQ, and then you get all these tech companies in one shot. It's kind of amazing. Kind of amazing. Broad-based, but that's what these indices are. So if someone says the NASDAQ now, you're going to say to yourself, oh, that's where all the tech stocks are. If someone says the S&P 500, you're going to say, you know what? That is a broad representation of the economy. 500 biggest stocks in the economy right now. Just gives you a sense. Okay, the last part of our vocabulary lesson today is the Fed. What the heck is it? Who are these people? Why do they move markets? I mean this. This is really important because we talk about the Fed all the time. So the Federal Reserve, there's a structure. There are 12 regional Federal Reserve banks. Each bank has its own president. In addition, there's a board of governors. There are 7 members to the board of governors in Washington. Now, it gets more confusing because who actually votes on these interest rates? The Federal Open Market Committee votes on whether interest rates should go up or down. So that's the 7 governors plus 1 New York Fed president. The New York Fed president is a permanent voter. The 7 governors can rotate. Currently, it's this guy, John Williams. He's been there since 2018. The other regionals rotate. Total voters at any time are 12. Okay, so we have 7 governors, 1 Fed president, 4 rotating regionals. All the others can change. The New York dude is permanent. Why is he permanent? And, it's so typical of New York, right? Because we think who the heck we are. The New York Fed, though, isn't just another regional bank. It is exactly where all the stuff happens. That's where the Fed executes its decisions in the financial markets. That where it may, if it raises or lowers interest rates, it is buying and selling treasuries to manipulate the markets a little bit. It wants to add money to the market, remove money from the market. All this happens in New York. So the guy in New York has to be on his toes, has to know what's going on. We can't have a revolving door of Fed governors that come in and out. The New York Fed is doing all the trades. So say what you want. New York gets a permanent place. It is the center of the U.S. financial markets. Again, say what you want. I understand people would like to move it and make it other places. It's fine. Right now, it's the center of the financial markets, home to Wall Street, and where the major banks and trading desks operate, where they make all the moves. They add liquidity to the market in New York. They take liquidity out. That's money, right? They take money in, out of the market. They put it in. They flow more. They pull it out. That's how they control what goes on out there. It all happens in New York. So if they want to move interest rates, bond markets, liquidity, as I said, that's money in, money out. Money flow is another word for liquidity. It all happens in New York. The Fed president of New York oversees the open market operations, the buying and selling of treasuries. So he is constant. He has real-time insight. He's your man. He's in place. So they're not just setting policy in New York. They're actually implementing it. Now, the thing is, right, we hear from these Fed presidents, like they'll come on the news and they'll start talking about stuff like, why? Well, because even non-voting members actually influence expectations. Markets are forward-looking. So when a Fed president says, we may need higher rates, everyone's like, whoa, what's happening? And then someone says, we may need lower rates. And they're like, why? What's going on? Is there too much money in the market right now? Is there not enough money in the market right now? And the other thing I will say about the different Fed presidents, when they all come on, whether or not they vote, they do represent different parts of the country, right? So the Fed president in New York might see a very different economy than the Fed president out in the Midwest. And so we should listen to what they have to say because it's different. All right. The last thing I'm going to say about the Fed is people use hawkish versus dovish a lot. What the heck does that mean? If a Fed governor or chair or somebody is a hawk, it means they're a hyper-focused hunter. Think of like a hawk just coming in whoosh, to get its food. Locks in on its target, acts fast, doesn't hesitate. That's inflation, for instance. So a hawk sees inflation as a complete enemy, wants to go after it, aggressive, fast, move. Do what you got to do it today. So the Fed will raise rate, tighten conditions. Even if it slows the entire economy down, the hawks don't care. The doves, on the other hand, as their name implies, are calm and peaceful. They're stabilizers. A dove represents peace and avoids conflict. Keeps things steady. That's growth. A dove wants to keep the economy comfortable and moving. Doesn't want to shock it. So the Fed may lower rates or support borrowing, keep things flowing. It's not like a knee-jerk hawkish reaction. So the analogy in my brain is always a hawk hunts inflation. A dove protects the growth of the economy. All right, so why are some dovish? Why are some hawkish? Again, because they represent different parts of the economy. So what they're seeing in their part of the country may be very different from what the New York president is seeing. Some see slowing growth, others see markets on fire. So we need to hear from them and we need to tie it all together. So last thing, higher rates slow the economy. They put pressure on stocks. Now think about it. If rates are higher, you're not taking loans out. You're not building new buildings. You're not going to take a big commercial loan to build an apartment building. You're not. Higher rates slow things down. If there's a higher rate on your car, you might not get it, right? It changes decision. Lower rates now stimulate the economy. People want to go out and take a loan and build and put money into the economy. And then once you build that place, you're going to have to furnish it and you're going to do all the things. You're going to hire plumbers and electricians and completely stimulates the economy. So lower rates, in theory, support the economy, support markets. Inflation, as a reminder, prices rising over time. If your money isn't growing in your bank account or your investment accounts faster than inflation, you are losing purchasing power, right? Eggs was the thing for the longest time, right? Inflation kept increasing the price of eggs. Prices rising over time, basically prices rising faster than your wages going up, than your investment accounts going up. That is inflation. You lose purchasing power. Now, granted, the Fed doesn't control the market, even though some people beg to differ, but it does control the environment the market operates in. So that is their role, helping money in, money out. Does that make sense? If it doesn't make sense, reach out to me. The last bonus thing I'm going to say is, what the heck is the market? People say this all the time. Let's clean this up once and for all. The market is not, I was going to say a flea market. It's not a flea market. I was just at a flea market. It's not. It's not one thing, though. It is all the things. The market is stocks, bonds, sectors, indices, ETFs, all the things, all moving differently. So when someone says the market is up, you should be thinking, oh yeah, which part of the market? Is the stock part up? Is the bond part up? The market's a collection of stories. It's not one single headline. So know enough to ask questions. Dig deeper. All right, here's what matters. You just need clarity. And I'm hoping we got a little of that today with my little vocabulary lesson. Once you understand the language, once you understand the vocabulary, I mean, it must be on some level like going to medical school. Once you learn all the sciencey words, you semi understand? I don't know. Stop feeling intimidated, though. Start asking better questions. That's it. As a reminder, you were not taught this anywhere. You were not taught this. So we have no choice but to learn this stuff on our own. And it is never too late. And you start asking better questions, you start making smarter, better decisions. That's it. That's real. That's real financial literacy. Financial literacy is not being afraid to ask, what does X mean? It's vocab. It's just vocab. And maybe you could go outside and play basketball like my students did back in the day. All right, if this episode helped make things even a tiny bit clearer, that was exactly the goal. Understanding your money isn't about knowing everything. It's about feeling confident enough to ask the next question and take the next step. And of course, you got college kids or anybody in your life, people newly divorced that need to understand some of these crazy jargony words, send this to them. I'm going to send this to my kids. I'm going to force them to listen to it, quite frankly. All right, of course, if you want to keep the conversation going or need help with your own financial plan or your own financial dictionary, you know where to reach me, TracyBurnsWealth.com, at Tracy Burns on LinkedIn. And of course, you can find this podcast bi-weekly on Spotify, Apple Podcasts, Amazon Music, and YouTube. As I always say, clarity creates confidence. Confidence creates better financial decisions. That's all we're trying to do here. I am here if you need me. See you next time. Lebenthal Financial Services, Inc. is a FINRA registered broker-dealer. The content of this podcast is intended for informational purposes only and is not intended to be investment advice. The views expressed in this podcast are subject to change based on market and other conditions. Information about the qualifications and business practices of Lebenthal Global Advisors, LLC is available on the SEC's website at www.advisorinfo.sec.gov. Information about the qualifications and business practices of Lebenthal Financial Services, Inc. and its representatives can be found on FINRA's BrokerCheck website, which is brokercheck.finra.org.